warm welcome to everyone. I am Shreya Agrawal, and you are watching the season 2 of our series, Future of Dealmaking, Capital Privado in partnership with JSA. As companies around the world reel from the unprecedented disruption of the coronavirus pandemic, private equity may emerge as a source of capital uniquely suited to help businesses weather the storm, while in turn putting money to work in transactions at favorable valuations. In our second episode of the series, Future of Dealmaking, we are looking to unravel the big question. Do record levels of cash and a long-term investment horizon make private equity a good candidate for assisting in economic recovery? One needs to look at history for getting qualified answer on the one. In the past 2 decades, funds that started deploying cash following a crisis, such as 2001 to 2004, after dot-com bubble burst, or 2009, 2012 after the global financial crisis, actually performed 68% higher than funds whose vintage years fell during late cycle peak economic growth, such as 1998 to 2000 or 2005, 2007. In the next 1 hour that I have with this august or meaningful panel here, I would like to unravel some of the outlook for private equity, the opportunities that they had, the learnings, the unlearnings, more importantly, and more. Please help me welcome Satish Chander, partner at True North, a homegrown private equity firm with about $2 billion in assets under management. I also have with me Rohitashwa, Prasad, and Aarthi, Sivanand, partners at Jyotisagar Associates. Gentlemen and ladies, thank you for this, the first episode of our second season, Future of Dealmaking. I'm looking forward to having a very meaningful conversation with this August panel here. I think, Satish, why don't I begin with you, just taking a segue from my introductory remarks as to where we are in the cycle of private equity here. I want to really understand from you that private equity returns are really measured based on vintage year, often defined as the year in which a fund begins making investments in underlying companies. It would be a good idea to understand from you that how do you think that 2020-21 will really sort of pan out as a vintage for private equity? I mean, what we are seeing is that there's just too much capital available. The private equity is sitting on huge piles of dry powder. Does that really make private equity a good candidate for assisting in economic recovery? What really is your sense?
Sure. Good afternoon, everyone. Thanks, Shreya, for this opportunity. So just picking on that, so let me use a different lens, Shreya. So just in terms of how much capital is there, I think broadly then we look at it. I know we put a broad brush to it, but broadly the way we think about it is that there is late stage capital, there is early stage capital, and of course there is a lot of capital that come into public markets, which is in a way competing with the capital that we provide. So if you look at it on a broader time frame, yes, there has been a lot of dry powder overall when you look at private equity space. But this is not a recent phenomena. I wouldn't say that there has been a material change in the last 15, 18 months. In fact, I would say that it's got a little better in the last 15, 18 months. There has been no fundraise that have happened. So to that extent, there are quite a few deals that have happened. So what we see is there is a bit of normalization. I know I'll come to the early stage later. There have been a lot of deals. There have been a lot of funds which have been drawn from a global pool. But in late stage, Srija, what we notice is at least private equity has evolved and matured to an extent that even when we look at deals, normally when you look at a lot of dry powder, you must be seeing like 4 or 5 funds coming in, bidding one over the other, bidding up to prices. I think the firms have matured to an extent that we don't see this happening a lot. Even when we have either won deals or lost deals, the differences has been, it's not the price. The price has been in that 5%, 10% bracket, which is a plus or minus where given anything, I think people have they will get an opportunity to match. But I think we have either won or lost based on other factors and not just the price. So to that extent, I would say that yes, there is capital, but it's not affecting prices so much. But if let's pick only on 21 because that's the time frame if you have to pick. I think one material difference that has happened is the public markets. Though the transmission of liquidity, there is liquidity. I think all the central banks have opened up. There is liquidity unquestionably. But for that to get translated into movement into private equity, there is a lag effect. Funds have to get raised and have to come in for deployment. But in public markets, it's quite seamless. There is an asset allocation, quickly it flows into the public markets. And we have seen the prices in the public markets where it is at really high levels. Therein lies the tough thing for us, because at the stage that we invest, for a founder, our competition is actually the public markets. He can go to the public markets and raise money. So in a sense, their expectations have gone up, saying, why can't I go IPO? I can get it at a good price. So that is a factor. I wouldn't deny that plays out. But I guess the way to think about it, at least how we think about it in True North, is we have to stay disciplined. There is no other mantra to this. You have to stay disciplined. I think for us, at least, our focus on few core sectors work, in the sense that we track it so much that we are not we don't get swayed by happenings in the last one quarter or a last month or a certain blip, because we work on these core sectors. We have been working on this for years together. So for us, at least, that helps a lot, not to be swayed by either valuations, because where we take a slightly longer view, and also in terms of developments in a core sector. And just to demonstrate, I mean, I'm not saying this only as words, that we have had a history. We have had a history where there was a lot of capital. It was difficult to do deals. Valuations were extremely high. And that's in our history, we have actually not deployed capital. We have gone back to our investors and said that we don't think this is the right time to be deploying and putting out capital. And we have actually scaled down our fund size, which is very unusual, which is hardly seen in our private equity space. But we thought that is the right thing to do, and we actually did that in our fund four. And that also reminds us to stay disciplined, stay focused, not actually get swayed by some of the things that happen as short term in the market. So I'll just pause here. I don't know if I've covered everything you wanted me to cover, but I'll just pause here.
Absolutely. That was sort of very meaningful and insightful, Satish. Two or three key takeaways that we can gather from here: that it is important to maintain discipline. You have had a track record and you actually returned capital to the LPs when you said that there was too much excess in the environment and you would not necessarily be able to put capital to work. And second, I think the fact that you said that, sector specific strategy is what you sort of specialize in, and that sort of helps you to not be caught by surprise and have more disciplined investment strategy. I sort of want to bring you, Rohit, in now and take a segue to sort of from what Satish just mentioned. What are the kind of trends that you are seeing in the market? Are you seeing excesses building up? I think Satish was very, very firm when he said that in late stage equity, one can't really deny that public markets are your huge competition. What really is the sense that you are gathering?
Yeah, Satish has very succinctly put what the landscape presently looks like and what are the issues that private equity investors will face going forward. When you talk about this vintage 2021 and the returns that it is expected to generate. So you see, let's and going back to the themes that Satish has touched upon. There is no doubt that returns on PE investments during a downturn, which in India actually started just before the pandemic last year, tend to be higher. So these by themselves could lead one to expect that the 2021 vintage will be an outperformer one. But this may be a right time actually to pause and look back at history, both the issues that you and Satish touched upon, and see if there is anything that one should be wary of and what lessons managers can draw from it. So, when we look at 2005, 2008, which were the halcyon days for PE investments in India before the last global financial crisis hit, and during which the PE returns dipped significantly. Today, some of the parallels are somewhat striking. So we have 2019 and 2020 seeing the highest volume of PE investments ever, followed by a softening of the macroeconomic situations, which led to a downturn, which actually began, as I said, at the end of 2020, just before the COVID pandemic started hitting us. So in 2005, 2008, the investors overestimated the size of the market. Secondly, they were very bullish on the GDP forecasts as well at that time. This led to, what Satish also said, an increasing number of GPs chasing a smaller number of deals. Now, and that in turn led to a slackening of investment discipline. Average transaction sizes increased. Managers became less discerning of sectors, optimistically investing even in those which were capital intensive, illiquid, and perhaps had longer exit times. So as a result, what happened was that when the downturn came, returns were hurt and exits became scarce. Some of these risks and trends are visible as I see even now. So when you look at the number of investable companies in India, their size continues to remain relatively small compared to the other emerging markets. And the GDP growth forecast for FY22 after a gap of several years is now again in double digits. Now, but that could be because of the significant contraction in FY 2021 itself. Thirdly, and this is a very important issue, I feel that capital markets with which P in India historically has competed with for valuations are overheating, thereby creating a pricing pressure on private buyers. So we could very well fall into a situation or enter a situation where the dry powder that we are seeing will result in GPs having more capital than reasonably can be invested. So the market could very fast turn into a seller's one. The same situation as at the end of 2008. Now, if that happens, then returns again could belie expectations, notwithstanding the opportunities that the present downturn presents. In this context, I would like to highlight two facts, which I feel are quite illustrative of the situation that we face ourselves in. First, the massive, unprecedented volume of investments in 2020 has primarily been on account of large deals above $100 million ticket size, with the average deal size going up and money flowing into select sectors. When you juxtapose that with the fact that in 2020, the number of exits actually declined, with value declining by almost 35% from the previous year, and also the number of exits, the actual number of exits also came down. So this means that on the one hand, that those sectors which are expected to benefit from the pandemic already have seen investors making a beeline for them, and arguably stressed valuations. And those whose future does not look that rosy may be difficult to exit as easily. So therefore, I think it's too early to tell how the 21 vintage will fare. Its performance will might very well depend on the lessons that fund managers have learned from history and the discipline and prudence they bring to their investment approach. At a fundamental level, they will need to tread cautiously. They will need to get their investment mix correct by focusing on sectors which have the right kind of macroeconomics for the cycle that we find ourselves in, and above all, liquidity. So therefore, the role of sector specialists within PE firms in making investment decisions will also come to the fore. So, broadly, I mean, what I have basically done is that I've developed on the themes that Satish has touched, because those, in my view, are very pertinent for how the 21 vintage, when we talk about its expected performance, could turn out to be.
Thanks, Rohit. That was insightful. Essentially, what we really gather is that there are parallels being seen from the benign days of private equity to what we are seeing now. And there's a word of caution coming in from Rohit for fund managers that perhaps avoid the excesses that we did see in the past, and perhaps a sector-specific strategy can come handy during these times. I want to sort of understand from you now, Satish, that just sort of, I think it's a beautiful segment to our next sort of discussion point. There have been learnings in the benign days of private equity. We see, liquidity easing again phenomenally. What are the kind of learnings or unlearnings that you've had, of private equity during this pandemic time? And what does that really mean in terms of portfolio management, in terms of exit strategies, in terms of perhaps how you look at the investments? And I think one particular theme that we are seeing is really stressed in the market right now, as if that is the nirvana moment for private equity or venture capital in general. We are seeing so much investments happening in technology. And I think simply so because the pandemic has really accelerated the adoption of technology across industries. So I think two key aspects coming from you on to sort of pick up your brains on really on the strategy and allocation or exit strategy change during the pandemic time. And secondly, how do you view as technologies uprising in the pandemic as investment thesis?
No, sure, Shrija. Let me also use a couple of points that Rohit said, where I have a slightly different viewpoint. Yes, number of deals have gone when we are comparing with the last phase. If you have looked at it, I think the volume and the value has gone up. And I think the way we cut it is if you just exclude one corporate out of it who have raised in two specific instances,
That is true.
actually the value is not unreasonably high. It's quite par for the course, and it's not been very high. Second one, I think Rohit's observation is right. It's not like GDP has grown a lot, but there is an increase in deal size. I view it slightly differently in the sense that for the same funding, I think private equity as a source of funding, there has been some maturity or opportunities that have come up. And what I mean by that is, just if you take, like, for example, pharma or healthcare. Earlier we had only minority deals, but I think it has matured to a certain extent where we are seeing majority deals or control deals. We are seeing buyouts, uh, primarily coming from the fact that companies, as they are looking at their overall corporate strategy, be it in healthcare or pharma, I think the way they have thought about it is, what do I really need to focus on if I'm having a funding constraint because of what the pandemic has thrown up? Should I focus on just the core, and can I divest few assets and create funds for growing my core assets? And what that has done is it's led to buyout opportunities, and some of these buyout opportunities are obviously large deals. So in a sense, buyout and control as a theme in private equity has been late to come into India. I know we have been betting on it for a long time, but it's been late to come here. But I think it's finally come here. We are seeing several opportunities there. And therein you see deal sizes going up, but it is all on the back of actual need, even in terms of some companies raising that capital and it coming in the form of buyout opportunities. Now, broadly, now stepping back in terms of what has pandemic taught us, how are we making tweaks to our, let's say, investment strategy? I think we went through an initial period where there was a hesitant. We were just hesitant in terms of looking at deals. We just thought that we don't know what is the impact of COVID, how is it on different sectors. There was a lot of uncertainty. It wasn't just COVID; it was just what is the impact of lockdown on the different sectors. So we just saw a period where I think, and this is when I don't speak for only for my firm, I speak for all firms and the entire ecosystem, bankers and companies included. There were fewer deals, but I think as companies saw the need for capital coming from two things. One is what I earlier spoke on, with the fact that they needed to raise that money for restructuring, focus on core or divesting few assets. Second, some companies just saw explosive growth, and that's where you were referring to in terms of some new age technology companies, or technology based or online based companies raising capital, all on the back of there was just an explosion in opportunity. They just saw an opportunity, they were moving in fast, that required funds, and there was private equity which was coming in and providing that long term capital. And I think that's essentially what we saw. So we saw that happening. So the number of deals started to increase, and I think people have adopted now in terms of how to work through lockdowns, not traveling, and actually going and consummating deals. Be it diligence, being lawyer negotiations, being agreement finalization. I think that there has been a lot of rethink and uh, reorientation that everyone else has gone through. Now, in terms of investment strategy, is just tweaks, if I have to say it. And I think what we are using is a in additional lens. We always had a lens in terms of how we looked at companies. We started using an additional lens in terms of analyzing the impact of pandemic or impact of COVID and lockdowns on medium and long term opportunities that a company has or a sector has. And what I mean by that is, and I don't mean just a lockdown, it's just that the market has changed, consumer behavior has changed. I think the orientation to digital mobile, if we expected that evolution to happen over 3 5 years, has happened over 3 5 months just because of necessity. So that throws up opportunities that throws up few disruption to a few sectors who are not fast enough to move. So that's the additional lens that we had to use to view each deal within our sectors of focus, to say that what's the medium term impact, what's the long term impact, and if we were getting comfortable that the long term impact is either neutral or positive, then we positively look at those sectors and those companies. And I think that's one of the key things that we have started doing. Second thing, as we are working with all our companies, we're just saying that you can't take anything for granted. You still have to maintain touch with your customers. You can't lose them. You can't use an excuse saying that nobody is coming to me, so I can't do business. You have to find a way of reaching out to them. And that's where, using digital, using technology, we worked with all our companies to say what's the best we can make out of the situation, rather than waiting for someone else to come and disrupt us. What can we do very, very differently to actually expand the scope? And I can give you various examples, and I think one that comes to mind is Cloud9, which is one of our investee companies. I think just the speed with which they moved online, in terms of, be it consultation, be it in terms of delivering medicines out, be it in terms of actually going closer to home and doing vaccination rather than waiting for patients to come to the centers and doing vaccination, or in terms of expanding boundaries of their market. You have an expert sitting in Bangalore, but you can use technology and deliver that expertise that everyone has, in terms of connecting to the medical devices which is there in, let's say, far beyond geographies where we don't have centers. You can actually, from those, just the equipments there, get all data, monitor that online, and have a protocol which is administered from Bangalore. So that's just expands the scope of doctors that you have in one location, and it expands their reach into so many markets. So it has thrown up opportunities. I think a lot of thinking that we have been doing with our portfolio companies is, how can you push boundaries here and use this opportunity, rather than saying that it has affected our subsector quite a bit.
That was sort of very helpful, and thanks for giving us this candid view, Satish. I sort of want to bring you and Aarthi here. We just heard from Satish, and I think he sort of reiterated the fact that how traditional companies are transforming digitally. I think if the two sort of words which have been used the most in the pandemic, it is digital transformation, and one really gets tired of it. But that, of course, is the reality. I want to understand, from at a time when every company out there is trying to label itself as a technology company, are you seeing a deal making more skewed towards that? What are the kind of trends you're picking up from deal making in general, in terms of the market dislocation this pandemic is throwing at us?
Yeah, sure. Hi. Thanks, Sheeta. You know, you're right. I mean, the buzzword is really how companies are adapting to tech. In fact, a couple of my clients did mention right after the pandemic struck that when they, at the very first, right, when they looked at their whole portfolio companies and saying, some of them don't have good internet to even speak on Zoom with your investors, right? So right from there, the way companies have really scaled up to say, now I can conduct entire board meetings, shareholder meetings, there's e-polling, there's, e-voting, everything is done on poll. There's just been this, super disruptive, growth that this entire industry. And what I mean by industry is not just the Ps, right? You have Ps, you have VCs who are at a very different end of the spectrum, lawyers, bankers, that whole deal-making ecosystem just did this quantum leap that none of us would have ever thought of, before, whether each of our organizations were equipped with that kind of infrastructure or not, as soon as the pandemic struck. So, yes, and so some of the clients did mention that they would never look at a target again that could not do that sort of jump, right? That could not look at scaling so quickly with technology. So yes, that was very important. And as far as, what are the sort of big reactions you see to deal making post the pandemic, or rather in the pandemic times? I would categorize it actually into three buckets, right? You have how the PEs, who are like the blue chip sort of fellows, Satish included, who've really cracked it, how these portfolio companies can actually be given that fillip. How do you help them do that bolt-on acquisition from there, even if the fund is not doing a new investment? How are they restructuring? So all of that is from the PE side of things. Then you have the VC side, and then you have the government and the regulators who are really, the most important sort of plug to this whole ecosystem and how various actors are behaving. So here I'd like to, point to three things. One is from the PE's side. They very quickly got the memo, right? The exit by PE and VCs plunged to a 6-year low and reduced by almost 53% by value in the first 11 months of 2020. So that's Jan to November, just in the thick of the first wave, really. And so what you saw there was, they very quickly abandoned strategic sales, M&As, those kind of laborious negotiation involved mechanisms for exits. And, and I think Satish spoke of this in the first question too, very quickly jumped to saying, how quickly can I do a primary market exit or an IPO? So those were the number one preferred modes. And only if that couldn't happen for whatever reason, then they moved into strategic or M&As. And then further down was, okay, even if that was not going to happen, then how do the portfolio companies add value by doing bolt-on acquisitions? So that, I think, was like a big trend we saw in deal making from what we saw coming in from PEs. PE funds also very, quickly, of course, looked at the numbers and said returns will take a hit as a result of significant write-downs in portfolios. Although we do hear that, some portfolio companies, obviously of some sectors which are tech platform driven, did not really suffer that much in terms of portfolio company valuation. So their tech played a role, and it became the distinguishing factor between companies on how value happened, how exits happened, etc. Exchange rate volatility and all of that, helped with exits and what mode the PE funds chose. What we also saw in PE funds that were raising capital is the composition of LP base shifted dramatically, right? So while there's always been interest in emerging markets, with international institutional investors being constrained in the asset allocation, you could see a lot more of the DFIs were looking at, coming in directly, almost, complemented or stood shoulder to shoulder with PE funds. So that's another significant trend we saw, impact investments and DFIs calling on us now to do some of these investments. 2 points on the VC side is, VCs are a different bucket. So there, when you look at it, they need significantly more hand-holding that they needed to do for their portfolio companies, which were at a very different, growth stage. So over there, the VCs, the pivot that those companies needed to do, again, came from tech, right? So they helped navigate these companies out of economic crisis by depending heavily on the tech platforms. They looked at saying, how can I look at partners in rebuilding the sectors in which these portfolio companies work? So we saw a lot more clients calling on us for partnership agreements, more master service agreements, renegotiation of agreements with existing vendors, customers. So they just needed to just reformulate that whole Rubik's cube, of all of these partners who they used to work with, and just by moving those around, they significantly leveraged their strategic and operational know-how, for which they are obviously there, the VCs. And they supported the structural change, quite fantastically. So we really were quite pleased to serve a lot of the VCs who worked on these kind of. And I think the last one I want to touch is the government and the regulator. Sometimes regulators get for messing around with regulations, adding clarity and value addition where it may not be always welcome. All of that, 3 or 4 significant things happened. One is they supported this whole, tech pivot by really not regulating too much. So I think they left it while we have, master legislations coming out like the labor codes and all of that. Just now, there was not too much nitty-gritty in terms of how platform workers work. And last year, of course, they changed the rules of game for insurance. And they, upped the cap over there for FDI and therefore promoted a lot. So, it's been an exciting space during the pandemic and post, barring the tragedies of humanity. But, tech has given that fillip for the industry.
Thanks, Aarthi. Thanks for that. I think tech definitely has been a fillip for the industry. I sort of want to sort of bring you in, Satish, just given that we have you here and you look at the healthcare space at True North and you have a history of looking at the healthcare space in deep dive. there for quite some time. I still really want to understand from you, how has the healthcare opportunity really played out in the pandemic? One really can't forget the fact that it is essentially a healthcare crisis. And, this pandemic is one that's unprecedented and can change generations to come. Everything, economics, culture, communication, everything is bound to change, just given as we sort of get away from the pandemic. I think one key observation that I've had, post pandemic, since we're already in here, especially with the healthcare sector, that perhaps we are kind of moving away from a very disease reaction oriented healthcare regime to one which is throughout the year well-being regime. Earlier, people used to only knock at the door of the hospital when you have a disease, for instance, when you are really ill. But now I think it's really moving to a space where throughout the year you like to sort of be well, tracking yourself more closely. So, how has that thrown up greater opportunity in the healthcare space? What aspects within the healthcare value chain you find more lucrative, and what you think are perhaps overhyped also?
Sure, Shrija. So yeah, I'll split it in two. And when I say healthcare, I look at healthcare and pharma as two different buckets. So let me speak on it both of these separately, because I've had like extremely diametrically opposite sort of opportunities thrown at them. So just on the healthcare services, you're right. I think it's an irony. I think they are at the forefront in terms of helping everyone tackle COVID, but at the same time, they are the ones who are most affected. If you look at overall effect on the entire sector or company, they are the ones who are most affected. Very ironically, they are the ones who are fighting the battle on the ground. So that's an irony. But I think what it has done, it has highlighted the infrastructure shortfall that we have in the country. And that's one thing that has come out of the pandemic. So if I broadly step back, if you look at how healthcare services has, and in healthcare services, there are various things that go in. So there's the entire the treatment space, which is again starting from quaternary tertiary care hospitals to secondary care hospitals. And then there is the entire clinics front, there is the entire diagnostic services. So I'll use all of them as healthcare services when I speak here. So I think what it has highlighted is the infrastructure shortfall across when I say quaternary, tertiary, secondary, there is a shortfall. Um, I think what people forget, and if you have to step back, if you look at it, there's always been a supply-demand mismatch. This is a high investment, high gestation sort of a sector. And it requires investment and it requires patient capital because it takes time for that capital to throw returns, and that's where private equity has always supported this industry because it traditionally fits in quite well, right? It's long-term capital, does well. There is a supply-demand mismatch. You can see the secular growth. Now, always investment has come from one is private equity, but before that, investment or supply has come from the private sector. It's not the government sector here. It's always led by the private sector, and that funding has come from private equity. Now, while that has been going on a secular basis, in the sense that there has been addition to the extent that the private sector can, I think I see that in the last 3-4 years there has been a bit of a pause. I think coming a lot from I think just championing price or affordability had become a mantra, and in the sense that people just chased costs, keeping costs down. I know anecdotally there might have been one or two cases, but broadly there was let's say inordinate focus on cost and pricing. And while the market takes care of itself, I think broadly, if you look at it, healthcare is a very pure. It's almost like the true economic competitive market, in the sense that supply demand keeps matching each other. Nobody runs away with inordinate pricing. The minute it does, there is additional capacity that comes up. It balances itself quite nicely. But when there is an external let's say a signal that comes in terms of regulations, be it in terms of regulating part of the prices like stent prices, implant prices, or in terms of any in terms of what more can you charge, like two governments, at least two state governments started introducing draft regulations. I think what that signaled is that if somebody is making a long-term investment over 5 6 years, and I'm speaking of founders and companies, they just think twice, because they're saying, then if I'm making an investment for 8 9 years and suddenly I see that I get surprises in terms of some pricing being controlled or margins being controlled, how should I think of this? Should I invest or should I wait till I get clarity? And I think everybody has been on that wait mode. So the focus, instead of being in terms of capacity and quality, shifted a lot towards uh, efficiency, in terms of cost efficiency, in terms of capex efficiency, in terms of saying that, okay, let me not no only focus on new capacity creation, let me show even investors, public or private, in terms of what can you do in the existing assets, how much can I squeeze out. So there was a lot of focus on that, to the extent that, let's say, supply creation or capacity creation has taken a bit of a fall. Now, when I look back, I think now everyone realizes, in terms of where we are, and where it is probably coming from. So what I'm hoping is, at least there has been short-term pain, but there has also been, I'm hoping, realization all around across the ecosystem, that somewhere this has to be corrected. So the good thing that I take away is that, one, uh, of course, companies have become far more efficient. They're focused on productivity, they're focused on efficiency, they're focused and re-looked at everything and made it a far efficient model. Because earlier, if it was inordinate growth focus, what's required is also focus on capacity and quality. And I'm hoping that what we are going through now, that focus is again going to come back, in terms of create capacity, build in that the right quality and provide that. And I think that is going to come up. Also, in chasing that efficiency, people have started looking at all their process systems. I gave you a few examples even in Cloud9, in terms of using technology either for their internal efficiencies or in terms of how they reach out to consumers or patients. And I think on that, again, businesses have got quite good. So overall, if I have to synthesize, summarize, I think they've gone through a pain, and I think in this pain they're all coming out much stronger, in terms of what they have learned and what they have focused. I think everyone's realized that there is synergy benefits that you can get if you operate as a large chain, in terms of how you efficiently move around your factors and inputs. And I think we see a lot of consolidation, which we've always been saying year on year, saying that it should consolidate. But I think this has actually been a trigger, for at least the initial consolidation moves, like Manipal buying Columbia Asia or Max buying quite a few hospitals. And I think that's another important trend. So overall, you see the sector becoming stronger, and similar trends, again, in diagnostics and primary care. And I think we continue to stay very interested in this. Another one which has taken a pause during this time is the entire medical technology. When what we mean by that is the consumables that go into a hospital space, which is in terms of stents, implants. I know there have been price regulation which has impacted them a bit, but that's something that India can do quite well. If you look at the China comparison, it was largely led by MNCs with hardly any domestic player, but it's completely flipped the other way around, with the domestic players coming to the forefront. And I think we are in the initial beginnings of that, even in the Indian market. We see several stent companies doing quite well in India, and also making inroads into Europe and trying to target the US markets. And I think it's a great opportunity if they can actually make that full transition. I know we are at a pause, but that's something that we continue to track. Now, briefly, I'll touch about pharma. I know we spoke a lot on healthcare, but briefly touching on pharma, I think the limelight, I think domestic formulation or catering to the domestic market continues to do well. I think that is a secular growth that we see. It's come down a bit last year, but I don't think anyone has doubts. Everyone continues to focus on that. That continues to be a focus sector. But I think the material shift over the last 4 years, and even more highlighted in the last 1 year, has been on India as a manufacturing destination in pharma. I think that's one, and this happened 3 years back as China was tightening its environmental rules. There was a lot of opportunity for Indian manufacturers to increase their share in that entire outsourcing market, and be it in API or be it in terms of CDMO in the early stages and manufacturing for innovators. I think there was a huge opportunity that Indian manufacturers got. And I think that's got even more highlighted in the entire pandemic area, where people wanted to diversify their supply base away from China. And this is a great opportunity for manufacturers. They can deploy, create capacity. This is essentially, you need to create capacity and cater to it. I think they have the capability and the skill. And this is where I think private equity can play a role. And it has happened. You see many deals which have happened on the back of this theme. Both we have done and several firms also have done. And I think this is a great opportunity. This is if you look at India's space in the overall global industry, I think this is a very almost like a curve changing sort of a year. And obviously everyone is quite bullish on it, and similar with us. I think I'll just
I,
Pause there, yeah. Aarti, you want to say something to sort of what
yeah.
Satish said?
Sorry,
Go
I
ahead.
was just,
Yeah.
yeah, I was curious to ask Satish, what was his take on just the state of all these primary healthcare centers, right? Yes, the PEs are sitting in, in more of the metro cities. We're looking at, you see where I'm going with that question. So where are these PHCs? Who should be looking after those set of people who can't get that kind of funding? What's the future for somebody who's not in a metro, who's in a tribal area, where you have a PHC that has to cater to you? It's a state subject, so center can't set in over there. So
yeah.
just like your 2 cents on that, just because you looked at this sector so deeply.
Sure. Yeah, complicated question,
Yeah,
Aarti, and we also thought about it. So, okay, let me step back. I wouldn't, let me not put a geographical split to this. I think overall primary care has not, organized primary care, let me put it that way. Organized primary care has not taken off in India. And we have looked at several models. It has been difficult. We have invested in several companies where they have a Middle East operation. For example, Aster and Kim's, they have Middle East operation. There it works very well. They're very organized primary care that works well. And So if I have to compare, why is it different there? Why is it not happening here? And I think the way Indian market is, so first of all, it's not regulated in the
yeah,
sense that if you look at any other market, you need to have a certain minimum standard in terms of opening up a primary care, be it in terms of how it's constructed, the safety aspects to it, the quality aspect to it, what minimum instruments do you have, what minimum airflow do you have. So it is regulated. They have to be of a certain minimum quality, and they give out licenses based on how much is required in a certain area. And not anyone can come and start a primary care center, right? It is quite difficult. Second, it is insurance covers primary care very widely in the other countries, and especially in the Middle East, insurance covers primary care or in terms of OPD, and that means that when if you have to interact with a organized institution like an insurance, a single doctor can't do it. So then again, it lends itself nicely to organized chains. And what organized chains bring in is that you can control them in terms of a minimum quality. You can control them in terms of the efficiency which they run it. They can bring in synergies because they are doing it on a much larger scale. I think that those are the ones which are missing here, because your competition here, if you run an organized chain, if you set up, and several of them
so
have
you're
tried,
saying the ecosystem has to grow a lot more in
has
order
to
to
grow.
support a
Has to
PHC?
Yeah, it has to grow. There has to be a certain minimum quality, because otherwise you're competing with a neighborhood doctor who is operating out of his one room. He's taking cash. He takes in terms of because there is no cost accounted. There is nothing that he has to answer for the minimum ones that he
Yeah,
has.
yeah.
So it just that's if that's your competition, you can't have prices which sustain a certain quality. So to answer your question, if you now you need to get PHC, I think it's far better job if the government steps in and does that, or does it like a PPP model. But if
But
you
the
look at,
government has been sitting on it, no, for a long time on the PHCs.
I know, but see, either you have to bring in a PPP partner and do it. Either you have to do it, which you have to spend, that's a
Yeah,
will, or you have to construct a nice PPP model which makes sense for private players to come and do it, or you have to change the overall economics such that it becomes natural for people to come and actually do it on their own. But
yeah.
unless those are one of the three routes. But as the conditions stand, would someone actually? It's quite difficult even to get a doctor to go and sit in a tier 2 town. because there's already paucity of doctors. Doctors are sought after everywhere. Why he would rather do a business in a metro, charge a higher fee than actually go into. So there is a push that is required there. That push
Yeah,
can come from
Maybe
various.
the pandemic is it.
Yeah.
yeah,
I think we should take the conversation forward
Sure.
and really talk about the healthcare opportunity and not sort of going deep into the healthcare space because we have to cover quite a few aspects here. I think so taking a segue from what sort of Satish spoke about the healthcare and the pharma opportunity and how he's seeing that sort of pan out in the pandemic. Rohit, I want to sort of bring you in. What are the kind of trends that you are picking, especially in the healthcare and the pharma space and the investment side? Yeah.
right, right, sure. As Satish pointed out, you see, healthcare, as the phrase, the term is used, is an umbrella one. It encompasses within itself a number of segments which are diverse, complex, with each having their own specific issues, challenges, and growth drivers. And COVID's dislocational impact on the sector is actually reflective of this segmentation. So, for example, when we look at the year that has gone by, most of the hospitals, were operating at 50-60% capacity. There was a high margin elective procedures were and still are not being carried out. That in turn has also impacted the procurement of high-end medical devices by hospitals, which saw a decline. And diagnostic services they were swamped with COVID and other infectious diseases related testing. On the other hand, when we look at segments like pharma, that showed a lot of promise and is going to continue to do so, uh, for reasons that Satish pointed out. There is this continued efforts to shift from China, particularly for manufacturing APIs, for which the government has also started giving incentives for under the Make in India program through its PLI schemes. Then we saw biotech companies joining the efforts to discover drugs and vaccines for COVID. And there was a huge revenue growth for a consumer wellness, consumer health and wellness products, such as sanitizers, PP kits, and protective gears. And this is actually reflected to some extent in the PE investments that were made in the sector. So whilst, in absolute terms, in the first 3 quarters of 2020, investment in healthcare fell by almost 12.5%. This decline was concentrated in hospitals, medical devices, and clinics and diagnostic services. Whereas pharma, biotech, and consumer health segments actually saw increased fund inflow. Now, so far as the opportunities that are there, Satish has already talked about, the yawning gap in infrastructure, and we all know that almost 70% of the hospital beds in India are going to be provided by the private sector, in which there is a lot of scope for and requirement indeed, for PE investments. One or actually two segments within the healthcare sector where I see a lot of opportunities and where I see scope also for companies moving up the value chain, which is what you talked about, happening, and as a result of this COVID pandemic, and also in some sense a sort of a natural progression, is that what I am seeing is that the COVID pandemic has opened up the field of medical technology, telemedicine, and virtual health, which came into their own in the last year or so and are moving center stage. So businesses which are engaged in the modernization of healthcare with wide use of telemedicine and virtual healthcare and associated technologies is one area where I feel there will be significant opportunities for PE players in the sector. Now, in the mature economies, of Western Europe and the US, healthcare companies with strong tech focus and components historically have not only been valued higher, but they have provided very high returns on investment also. So both as in terms of the EBITDA multiples, and also in terms of the IRRs, they have done very well. And I feel that the structural factors are well suited for the growth of health tech in India. First, healthcare lags behind the other industries in technological penetration. There is public funding deficits, and pricing pressure is going to incentivize companies to adopt technology to reduce costs. Digitization, in my opinion, can also be used to increase compliance, monitoring of compliance in an increasingly complex regulatory environment. And above all, health tech companies are serving a rapidly growing but an underserved market. Now, it is true that the health tech companies in India are early stage, unlike their counterparts in the West. And therefore, one could say they are more attractive to VC investors than PE, and that is true. But I feel that therein lies the opportunity for those PE investors who can actually identify the maturing companies which have scalable products and services and can capture the significant upsides, the disproportionate upsides that there will be for early movers. So therefore, actually those PE players who have strong technology as well as healthcare sector expertise, like Satish's, in my view, are very well suited and cited to source and evaluate deals and grab this opportunity. Now, coming to the point that Satish made about medical devices, like stents and the like, they also offer very good investment opportunities. There is tremendous scope for import substitution in India. 80% of the high-end and high-margin medical devices are imported. Indian companies are mostly engaged in the manufacture of low-cost consumables and supplies. Now, with the frugal, low-cost innovation environment that India affords, I feel that there is a tremendous opportunity. There is a tremendous scope for grabbing that opportunity as well. And mind you, this medical devices segment is different from the healthcare technology segment that I talked about, because healthcare technology finds its applications as a support throughout the healthcare segments. Healthcare delivery, hospital administration, pharma and life sciences, and to a large extent in medical devices as well. So I feel that these are the segments within healthcare which afford very good opportunities for nimble companies and investors who have a keen eye for it to move up the value chain.
Rohit, thanks for that. I think we spoke quite a bit about the healthcare as an opportunity. We began our conversation about private equities, a vintage year, learnings, portfolio management, investment strategy. Aarthi gave us a broader view on how she looks at the pandemic, deal making across three broad structures. Rohit, you spoke about the fact that what the kind of lessons learned, what the private equity fund managers can draw lessons from the benign days of private equity. I think it's an interesting conversation. We're going deep and deeper into our larger question. I think it's very important to also ask and understand that how really has deal making changed from a legal perspective? How has due diligence changed in the wake of pandemic? I think it's an interesting question to ask that, how have private equity fund managers really been able to establish trust in a synthetic environment? And I think, Aarthi, I wanted to begin that with you maybe, because I remember you sort of referring to this, that, everything apparently is happening over Zoom, right? From your voting to board meetings. So how has this been for you? And then I will definitely want to get Satish's viewpoint on this. Yeah.
So it's been challenging, interesting. I've done Zoom calls with close to 40 people in a single meeting, and I think that's something that we did not envisage even in the pre-pandemic world, where everyone would need to fly into Bombay, red-eye flights, get there, sit there for 10 hours, and clients would lock us up, not literally, but it's all known for. Satish is smiling already. Lock us up in rooms and say no one's getting out till the deal is closed, and over the 2-3 days there's a Stockholm syndrome, and then the deal gets closed. And we've not had those luxuries, right? So deal making has changed because there are 40 people on Zoom, everyone's negotiating, all positions are open. So it's definitely been a significant lesson for Indians, just because culturally, we all like to speak together. There's like a lot of emotion in deal making. So I think the verbal sort of way of clearly expressing without having to be in the same room, but yet, get everybody on the same page. I think there have all been significant changes. And our associates and some of our younger colleagues have just been zapped at the level at which and the speed at which interactions have happened, because no one wants to be on Zoom for 8 hours. But I think that's been the most significant change. Also with international counsel, also in some transactions, right, across time zones. So we've all really matured, I think, as a legal industry in how you do online deal closures. Then you've also had the whole learning of saying, how do you sign a deal, no touch transactions, because, in the beginning, COVID was all surface transmission. So there's a lot of apprehension about how papers move across cities, places. Do you leave your papers for 3 days and no one touches it because the virus is going to stick to you? There were all sorts of concerns, right, when it began. And now, of course, it's like quite different. And now we're like, there's a pandemic and a Zoom fatigue. So yeah, executions are happening closer. Some have ventured to doing, in-person closings, but that's just the fun part. I think from the technical part of how deal making has changed, we're having to place a lot more calls to rep and warranty insurance providers. So before, clients would say that's an unnecessary increase in cost to deal, to pay premium for that insurance. But today, no one's thinking twice. They want to pay that premium because you don't have the flexibility to go and do that due diligence in person. No lawyer is available to go to, we did a deal in Madhya Pradesh, in interior Madhya Pradesh. Nobody could go there, right, between state lockdowns. Otherwise, they would have insisted a JSA goes down to Madhya Pradesh to whatever village, stay there in diligence. But now we were happy that clients could take a rep and warranty insurance and go ahead, split the premium into it. So significantly, insurance has gone up. It's getting absorbed in the cost of doing business. Second is there has been a significant change in valuations. So previously, there's just one line in your agreement that says pre-money valuation is so much or enterprise value is so much. This is your stake, this is my stake, and then you move on to, the legal rights. Now there are 2 or 3 pages to an agreement that is dedicated to valuation. And I'll tell you why or how without boring you too much with the legalese, what we call lockbox mechanisms, to a system of all post-closing adjustments. So you're coming into documentation, what I mentioned, 2 to 3 pages, where we're really saying, what is that post-closing performance related pricing, right? Which is a contingent price mechanism, which is like an earn-out that is contingent on the target company achieving certain financial metrics or targets during a specified period. Or the investors could say, look, I'm going to defer this payment to you till I see how, your supply chain works out, whether you're actually able to meet, delivery to customers. I mean, how is your P&L really shaping up? So the deferred payment of a portion of purchase price, which is linked to a future contingency. And here there's no end to this future contingency. We're now on the second wave and we don't know where that contingency will actually end. So it required very, liberal collaboration between 40 unwilling people to write those 2 pages of what that future contingency is and how that valuation will actually get, fructified. Third valuation was also, there's a significant retention or a holdback from the promoter, usually saying we're going to hold this cash back because we're going to give this to you, and it's a pandemic, you might have a change of mind, you might disappear to be an Airtel super singer or whatever. So in which case, you want to hold back that cash. So retention or holding back of cash became a prominent theme to secure, potential indemnity claims that these promoters would have. And fourth, just the whole reconciliation between saying, okay, we agree to something now, 6 months or 8 months down the line, I want to reconcile how this business will actually pan out. So that whole reconciliation process and how that will actually be conducted during a pandemic, who are these bankers who would come in, who would do this fair valuation, who would do a physical inspection of stock and whatever was needed. how do you do a networking capital adjustment without ever seeing the promoter or his premises? Um, so parties were looking to negotiate these caps on adjustments to protect their interests. So these were, primarily our sort of painful joys during the entire process of writing these documents for these deals. And we didn't see a lot of this in some sectors, which is largely digital and tech, ed tech, online gaming, fintech, all of that. You didn't find these problems. These were more and more hardcore, manufacturing, healthcare, telecom. I leave geo out of it, but a lot of this, really required a lot of negotiations. And just two more points, I'll keep it short, is material adverse change. We are, of course, all in a material adverse change, but how did you define it? It was hotly debated, trying to lessen the ambiguity in how you drafted these clauses. And how would you invoke these clauses also? Force majeure clause, every common person who is not a lawyer, the most significant term they've learned in the pandemic is force majeure. Everyone's learned what that term
I
means,
agree with that.
right? What it includes, what it excludes, and all of that. So force majeure is hotly debated, and reps and warranties. Now, this is really, just saying, look, I'm a good person, trust in me, put the money in me. That's really a rep. And a warranty is when you say it all in a contract. So these reps and warranties became, again, extensive. They were as big as deal documents itself, running to several hundreds of pages. And only because, nobody knows about business continuity and operations. No one knows about solvency risk. No one knows about financial performance. Of course, we don't have a banker on this call who will say they know all of it, but most of it is from a legal documentation point. We don't know. And how will the material contract, be performed or terminated? Will a government stimulus have an impact on these reps and warranties? And what will be these materiality thresholds, qualifiers for all of these reps and warranties? These are all, really complex subjects that I think the legal community really stretched their brain cells to figure out ways. And I think we're now, post a year and 3 months, most of the law firms or lawyers are reasonably comfortable in taking hard calls for clients on what should really be that, Lakshman Rekha we are drawing for them, saying until that point, we are okay to underwrite the risk in the document. Beyond that, we're not going to stand guarantee. So there has been a lot of maturity in the legal market for deal making. And
yeah. Yeah, so I think that was sort of pretty meaningful and insightful coming from you. And I could see Satish, absolutely smiling gladly through the fun part when you were talking about the joyful pains which the legal industry had to go through. I think especially these are the people who put you through the entire turmoil of 8 hours of Zoom call. So it's on you now, Satish.
Yeah. A lot of people are misled by seeing the Suit serial, they think it's all fancy like that, and then you don't realize how horrible it is. Anyway, but it is fun. It's been a fantastic experience.
No, it has been. I would definitely agree with that. No, let me just maybe discuss other aspects other than just the agreement and the lawyers. And I think, the deal making has come a long way. And I think one is in terms of how do you develop comfort with founders if it's only through Zoom. It is a tough one, and I think I can give you at least the most recent deal that I closed. At least I had an advantage because it was in Bangalore. Nobody else could travel to Bangalore. I was we have an office in Bangalore, others don't, so it was a huge advantage, right? Having said that, I think there have been several other companies which are in my pipeline. I'm trying to build relationship, and it was all started on Zoom. Earlier, it would have been that I would have flown to Ahmedabad, or I would have flown to Hyderabad. Now it's been fairly easy, just in terms of setting up a Zoom meeting and having those conversations. What do I miss in that? I think I miss is that Zoom meetings tend to be nicely bookended. You start and you close. But I think when you met physically, there were many other things to it, right? You had a lunch together, then you had conversation on how was your flight, did it get delayed, who did you meet? I think that is missing, and I think people's calendar are so filled up now that it's very, very bookended. You get on, talk business, and get out of the call. So uh,
Yeah.
that is something that I miss. Probably we should set that up. I mean, I'm sure that can be done on Zoom too. So otherwise, I think even the other deal making processes, I think one is the comfort with the founder, but otherwise even others, I think it's shifted nicely. We have had some pharma investments where we had to do an operational diligence or a technical diligence. I think even during the tough times of travel, we have managed to at least one day get someone, but most other things, which otherwise it would have been like a 10, 15 day, they sit at the plants, observe many things and have those conversations. But because of the way it is structured, it was a one day travel plus everything else done remotely. Would before this happened, if you had asked me as a hypothesis, is this something that's possible, I would have said no. But I think necessity is forces all of these to happen, and I think that's turned out well. But for us, because we are sector focused and because we work through companies from even we look at companies for a long time before we actually do the investment. I think what has helped us to a certain extent is some of these companies we have already met once before. I know the new ones we are trying to build relationship, but at least the ones that we have consummated the deals now, these are all deals where we had met the founder before, so at least we had that relationship. But to continue it on Zoom is quite easy. But I agree with Aarthi, if we had to start and finish on Zoom, yeah, it is quite difficult.
Yeah, I'm sure. We're just hoping we
One
can go to the normal times. Yes, I think Rohit wants to say something. Yes,
Yeah,
Rohit.
yeah. Just wanted to add one thing. In one particular area of deal making, the pandemic has actually not disrupted it as much as one might have thought it would, and actually has led to a fair bit of efficiency as well. And that is capital raising in the public markets. The players there. It's a small clubby world. So I mean, the investment bankers, the auditors, the lawyers. It's the same set of people. So the working amongst them, coordinating working amongst them has not been impacted that adversely as in a situation or in a deal where you are building relationships with the members of the working group for the first time.
Yeah.
So actually, in public fundraising deals, a lot of efficiency has come in because now you can do everything on Zoom, and you can even do at least so far as the documentary diligence is concerned on the virtual data rooms. So there a fair bit of efficiency has come in. I mean that's been my personal experience.
No,
Yeah.
true, Rohit. Actually, I will take it a little further. I wouldn't say that it is not affected or it's only efficiency. I think it's become more far effective more than just
Yes.
efficiency. I
Yeah.
think the way it plays out is if I had to do physical road shows, right? I
Yeah.
might choose between, okay, I'll do East Coast, I'll do West Coast, but I
Yeah.
leave out everything else in between because there is a how much time do you spend? Do you take that flight? Do you spend that 2 days extra, all that? But now it's just another one more Zoom call, two more Zoom calls. It's just been that you're open to investors
Yeah.
across. So it's
Getting more
actually, I
bang
wouldn't
for
say
the
that
buck.
just efficiency, it's just become far more effective. The nature
Yes.
of
Yeah,
communication.
yeah. And you save money as well. You save money and time, traveling. So
So I'm sure at least there's some spaces and sectors are profiteering from the pandemic, and we are seeing a lot of efficiency creeping in. I think we are sort of running very, very behind time and schedule here. I think the conversation is just so interesting and unraveling so many various aspects to this. I think it's a good point to perhaps talk about really the elephant in the room. We spoke about diligence in the deal making, deal structures, how to establish trust in a synthetic environment, vintage year, learnings, portfolio management, structures, market dislocation, opportunities, spoke about healthcare quite detail. How do you establish governance, for instance, in a synthetic environment? What has this pandemic meant in terms of the communication between the investor and the portfolio company? Have the lines of communication increased significantly? It also applies for the GP LP relationship also. Have the LPs been more proactive meeting other GPs and perhaps more frequent? That is my first question. I think this entire narrative of the pandemic, as we have been jolted out of a black swan blindness, is also hinging upon the fact that how concerned we are for the environment. I definitely know that LPs are increasingly pressing in the investment charter that everything definitely need to be centered around ESG. I would sort of like to bring you, Rohit, in first, and then go to Satish on sort of his from a GP perspective. And Rohit, what you are seeing the trends in these two directions from the market at large.
No, that's a very a topical issue. You see, ESG might seem like an esoteric concept, but it is fast moving from being just a normative good practice value metrics to actually being incorporated in mainstream financial analysis. And it's all part of the evolution of a larger stakeholder capitalism, which is now recognizing that companies owe a duty beyond shareholder value maximization. And in line with this trend, and you talked about the heightened standards imposed by LPs, the fund managers we are seeing are on their part are assigning greater weightage to ESG parameters in investment decision making, in managing risk appetite, and above all as a factor for generating long-term and sustainable returns. And when you look at those companies which they don't control, it has become a handy tool for PE funds to engage with the promoters on a different plane. Indeed, I'll give you an anecdotal experience that I have seen at least in two instances where I have advised promoters in investments by PE investors, where the promoters have actually told me to expressly build into the agreements obligations on the part of the PE investors and their nominee directors to help institutionalize the ESG culture in their companies. So this, in some sense, is actually a positive development, and it's a two-way movement that we are seeing, not only on the investor side but also from the investing companies side. And very importantly, ESG makes for sound economics as well. Case in point, and I was looking at your own data, Mint's data, Shirija, is that the Nifty ESG index has over a 1 to 5 year period as of October last year surpassed the Nifty 50 by almost 200 basis points on a CAGR growth rate.
True.
So it is a material factor now in the long-term prospect and sustainability of the business. Now, I'm sure Satish will delve deeper into it. I will just quickly touch upon the regulations on the ESG front in India. Historically in India, it only has been the G part of ESG, which is governance, which has had a well-defined and regulated objective, standard, and criteria. And here I am referring to the provisions on corporate governance in the Companies Act. Now, for the E and the S, that is the environmental and the social norms, Indian companies have not really had their performance tested against any measurable criteria until the passage of the Companies Act 2013, which which has a fair bit of provisions on corporate social responsibility and the various rules that are made thereunder. Now, those also have been amended from time to time, and recently there is a movement towards making them directional, excuse me, towards making them mandatory rather than just being a set of normative standards. Then just last month, at the end of March, SEBI has expanded the scope of business responsibility reporting, which is mandatory for the top 1,000 listed companies, to include sustainability metrics as well. Now it is called the BSR report rather than the BRR. It is voluntary for FY22 and mandatory beginning FY23. So this non-financial reporting, in SEBI's own words, lays emphasis on quantifiable metrics across sectors and time periods, and has been made much more granular. From a PE investor's perspective, coming into a company which, let's say, I don't control and is not listed, I can very well rely on this and say that, why don't we use this as a ready reckoner for enhanced ESG governance and putting in place and institutionalizing that in my investing company. And promoters, I am sure, will be very open to that. So to sum up, I feel that the greater awareness of ESG and its incorporation into the regulatory framework is only going to have a positive impact on the industry. I mean, I feel that there is going to be a lesser need for fund managers to make arguable cases with the promoters of their investee companies to adopt ESG standards. And I am also very hopeful that this will lead to greater valuation enhancements of their companies at the time of exits. Now, and I am stressing on the companies where the where a P investor is just a minority investor, because that is where it becomes important when you, because you need to convince your promoter to adopt these standards. Now, where a P investor is actually in control of a company, has done a buyout transaction, there the dynamics are different, because there it is much more easier for the investor to put in place these standards without having the need to argue for both the economic rationale behind it and also the general rationale behind it. So I feel it's a very, very positive development.
Thanks for that, Rohit, in terms of how ESG is coming into mainstream finance and the fact that ESG also makes for good economic sense. I also want to sort of bring you in, Satish. What are you seeing from as a GP perspective? How is important is the ESG conversation increasingly? One, in your conversation with LPs, and second, in your conversation with potential portfolio companies.
Sure. No, very important. I have not too much to add to what Rohit said. He almost covered the entire thing. But just to substantiate a few points here, and I think uh, we as a GP view this very important in the sense that I think we go far beyond either regulations or valuations or even in terms of LPs. We in a sense that we as a firm decided that we want to be at the cutting edge of this, and mainly coming from leaving even valuations. I think we thought that valuation is more an indicator. Just if a company is more sustainable, has the right thinking behind sustainability, we think that there will be just good performers in the market. And when I say market, I mean talking about their consumer product market and the way they function and their longevity of the organization. So for us, we view it even from a philosophy perspective, this is something very important. And to that extent, that even in companies where, even if we are minority, we have had a long relationship with the founder. We don't have too much doubts on the promoters' governance. We still at least play that can we actually evangelize this, make the founder also see the importance of this and adopt this, is something that we are moving towards. To that extent, even to commit ourselves as a firm, because even to say that we as a firm, all of us have to commit to it and we have to take some steps to it. We also became signatories to UNPRI. That itself gives us a framework, in terms of it just gives us a holistic framework to go and have these conversations. Because earlier we used to do quite a bit of this, but it was a lot on EHS and governance coming from the Companies Act and overall true governance. But ESG being from the UNPRI framework is a far, far overall encompassing sort of a framework, helps us also in terms of actually look at all other improvements that we can make and actually have these conversations with founders. I think increasingly all founders also are beginning to recognize this. I think some through regulation, some as they also see in terms of how companies are viewed and how they are revered by few investors, or how they are how some public market investors feel comfortable with a few companies just because they have good ESG standards. That itself makes it a very aspirable thing for most founders to reach out for, even if they themselves already haven't done it there. So to that extent, it's a very, very important conversation. It's moving in the right direction. And just to add, Shrija, to the other question that you asked, in this pandemic time, have our conversations outside of just the ESG, how has our conversations panned out? uh, I think it's increased on both counts, both with our founders and also with our LPs. I would say that our interactions have got more, because earlier, even if we waited, let's say, for a monthly meeting to actually physically go and have a conversation on something, I think now to set up individual Zoom meetings and discuss many more things on a more frequent basis, we just see that we are more connected. Maybe all of us at the back of our mind are feeling that maybe we're losing connect because I'm not going and meeting him. Maybe we're all overcompensating that in terms of having many more virtual meetings to compensate for that one good quality physical meeting. So somehow, if I have to look back as you asked this question, I think interactions have increased, maybe because it is also more efficient to have these interactions now. And similarly with also LPs, I think because things are changing so much on the ground. Uh, Earlier, it was almost like India has gained victory over COVID, and now we are at the worst end of COVID. So they're also very curious on. We are reading these things, but what's happening on the ground? So they're also extremely curious to speak and understand. So to that extent, even our interactions with the LPs. And when I say uh, earlier, if it had happened only with one partner or one managing partner or another partner who was involved with the LP relationship, now we actually see it's a little more broad based. LPs reach out even to other partners, even to just get a 360-degree in terms of what's happening on the ground. Not so much so with just the firm, but even what's happening on the ground, what's happening on the different sectors. So overall, to answer your question, in this times, I think interactions has increased a lot between the different stakeholders and shareholders. It's much more than what it was before.
I think we had a lovely conversation here. I think about 1.5 hours of unraveling various aspects of private equity in the uncertain time and how resiliently it is emerging as an asset class which actually can assist in economic recovery. I think before I get on to rapid fire, if I were to just request each one of you one quick remark, like 3 sentences perhaps at the max, one key learning or one quick key observation, one key concluding remark, what would that really be? I can begin with you, Rohit, get on to you, Aarthi, and then with you, Satish. Yeah.
Well, as Charles Dickens said, it's the best of times and the worst of times. And, so there are opportunities galore, but one has to tread very cautiously and carefully and not get carried away by the massive stockpile of gunpowder that you have, dry powder, and then start firing your cannons. So if used judiciously, you can really ride the waves for quite some time to come.
Okay, Aarthi.
I would say, in the light of the health and, of course, humanitarian crisis we are currently facing, despite that, I think as a community, we've not let this good crisis go to a waste, sorry to say, because the business, financial, legal teams have all, worked through a lot of unprecedented situations, and deal closures have been reached at a record speed. So the nimbleness that has been demonstrated by the whole industry has, eventually will have a trickle down effect to economy and progress, I think, of the country as a whole. And, people being our primary asset with whom we deal with, whether it's founders or peers, it has been heartening to see really the professionalism and on-time delivery of services, across the industry. So that's been my primary lesson learned.
Okay, Satish.
And so the primary lesson I think is to, if I have to look back, is to stay disciplined. And in two cases, right, there are explosive opportunities that come your way, and you yourself are surprised saying that, wow, this is a great one. And equally, there are ones where you're completely bogged down in terms of how do we think about this in such an adversity. And I think in both times, it pays to be disciplined. And the other one that I've learned is, I think, if how much of our experience you have, how much of our distilled few mantras that you have, I think these are times which teach you to question everything on first principles. There's so many changes and so many surprises that are thrown. I think this teaches you saying you can't hold any mantra. Even if you have strong views, hold it lightly. You can question everything on first principles, and everything has to be thought through here. I think that's a biggest learning for me in this very, very uncertain and fast changing 12, 15 months that we have seen.
Okay, so first principles thinking for you. For Aarthi, it's about people at the center, and for Rohit, it's really about, not being swayed by the excesses and having a caution here. Now it's time for rapid fire. I begin with you, Satish. If you were to give me a deal which you saw in the recent times and you wish you would have done it,
Yeah, probably I'll take not recent times. There is a deal that I keep seeing multiple times, and I wish I had done it was probably Byju's. I've seen it since their maybe Series C or whatever, but I've somehow not done it, and I think that's been a miss.
So that really is your anti-portfolio. And what are you Netflixing these days?
Oh, multiple. It's mainly been on football. My son is a football fan, so we're like devouring all the Man City and all the Barca ones which are there on Netflix.
Okay. The same question for you, Aarthi. One deal which perhaps some other legal firm, law firm advised on, and which perhaps you think you could have advised on.
Actually, it's a small deal, but I like doing something in agriculture, and I think I like the Kotaram Agro that just closed this year. So it was a small transaction, but I think it's an interesting space, and I'd love to do agri deals this year, apart from everything else we're doing. Netflixing Money Heist.
Okay. Rohit, what about you? One deal which has sort of really left you overawed, and perhaps you wish that you would have done that.
Well, the RGO deals, definitely. Then that was a series of deals, arising out of one. So that would have been a very good one.
Although
Or
JSA was on it.
good ones. Yes. Well, one part of it. Yes. Watching a number of good history related period shows on Netflix. So I've watched the latest one that I watched is the Rise of Empires, the rise of the Ottoman Empire. In which there is that show focuses on Mehmet taking or defeating Constantine to take over Constantinople. And of course, I watched The Crown.
So thank you, everybody. Thank you for taking up your time and energy on Saturday and get a very fruitful and enjoyable discussion. Until the time I see you next, goodbye and good luck. And before we sign off, I do hope you and yours are doing well, and my best wishes to all of you. Thank you so much for coming on this show today. Thank you so much.
Thank you so much.
Thank you.